Welcome. Today's training will be on GASB 87 for leases. The purpose of this presentation is to provide an overview of GASB 87 for local governmental entities. With that said, the objective is to familiarize you with the concepts to account for leases using GAAP for governmental entities. For specific questions and circumstances not covered here, please see the GASB 87 implementation guide found on GASB's website. There are also other more comprehensive trainings available for the CPA community that can be found online. If you've studied GAAP accounting for leases prior to these standards, you're familiar with the concept of a capital lease and an operating lease. Sadly, or happily, depending on how you look at that, most of that knowledge is now obsolete and has been replaced by uniform guidance from the three main accounting standard setting bodies worldwide: the Financial Accounting Standards Board, or FASB, the Governmental Accounting Standards Board, or GASB, and the International Accounting Standards Board, or IASB. The good news is that if you understand how leases should be treated for financial or international standards used in the business world, then you'll also understand how they are recorded and tracked for governmental accounting standards. So that is a nice new thing. Also, I've noted here on the slide, the proposed implementation date for GASB 87 has changed from December 15th, 2019 to December 15th, 2020. So it's been a delayed implementation. Early implementation is encouraged. So hopefully this presentation is useful for you. Let's start by defining what a lease is. A lease is a contract that conveys control of the right of use to another entity's non-financial assets. Knowing the definition of a lease is important for local governmental entities because it's possible that the entity will be both leasing from and leasing to other entities. So a city may choose to lease heavy equipment or office equipment, and at the same time they may offer a land lease or an airport hangar lease or office space in one of their buildings to a state or federal governmental entity, or a private entity for that matter. At this point in the video, please take a minute, pause it, and write down any potential leases that might exist in your entity. We're going to go through a few examples, which might be more helpful if you run through them with an applicable example in mind that will affect your entity. Okay, so after identifying any potential leases, you will need to know what the term of the lease should be. The term of the lease should be specified in the contract and should cover the original lease period, options to extend the lease if it's reasonably foreseeable that it will be extended, and it doesn't matter if it is a leasee or leaseor option. As a rule of thumb, I would say that those options were written into the contract because one or both parties requested the option. So unless one of the parties have stated their intention to not exercise the extension, they should be included in the term of the lease. Exercising judgment here is important, and management should be able to explain why they're including or excluding an option to extend the lease to their external auditors. That conversation and the determination should happen before the auditors show up, and management should be explaining to the auditors why they've chosen to do it, and not the other way around. The next question that comes up is an option to terminate the lease. And it's quite common for governmental entities to include a clause that the contract can be terminated if a written warning is provided a certain number of days in advance. If you're reasonably certain, based on all relevant factors, that neither the leaseor or the leasee will exercise their option to terminate, then that period should be included in the lease term, even though there's an option to terminate it before that. Also, governmental leases have subject to language. The lease will continue subject to an annual appropriation, or subject to the governing body budgeting funds each year. Subject to clauses should only affect the term of the lease if you're reasonably certain that the clause will be exercised. So if there's a budgeting problem and the governing body has said, we are not going to fund this lease, we're going to let it lapse, then you'd make a change, but not until something has happened that would tell you that it's not going to continue. After the initial determination of a lease term, you should not need to reassess or redetermine the lease term unless there is an event. And those events could be either the leasee or the leaseor exercise an option, so they terminate or extend the contract in a way that changes the lease term. Either the leasee or the leaseor chooses to not to exercise an option, which would result in the contract being terminated or extended in a way that's different from the original lease term, or if there's a specified event in the contract that would change the original lease term. And the lease term is very important here. Understanding what a lease is and the term of the lease is the first step. If the term is less than a year, it's considered a short-term lease. The leasee records the current outflow or expense, and the lessor records a current inflow or revenue. An example would be a city that has a 1-year lease for a copying machine at $1,200. If the payments were made monthly and the lease were created halfway through the fiscal year, then the city would record $100 of expense each month through the life of the lease. Some governments, when they're considering leases, like the 1-year option because it keeps the accounting simple. The journal entry here would be, we're going to record rent expense and the cash going out. The next question is, does the lease transfer ownership? Leases that transfer ownership should be accounted for as financed purchases. In other words, the entity should record the asset and the corresponding debt. The notes to the financial statements should include the principal and interest and the applicable terms of the financing arrangement, like the beginning date, the projected end date, the payment amounts and terms. You can see the GASB codification 1500.129 for the disclosure requirements. And to illustrate this, let's look at an example. A special service district leases a backhoe with a fair market value of $45,000 for 5 years. The backhoe has a useful life of 15 years. And to simplify the example, at the end of those 15 years, we're going to say that it will be worthless. The lease calls for 5 annual payments of $10,000 each. The lease conveys or transfers ownership to the district at the end of the lease. And it is the intention of the district to use the backhoe for its entire life. An amortization table in an Excel spreadsheet can be used to calculate the amounts recorded as interest and principal each year, as we've shown on this slide. This is a simple amortization table in an Excel spreadsheet, and it's fairly simple to put together, but I wanted to show you one feature here. If you know the terms of the lease, you know it's for 5 years, you know the lease payment or the interest or the fair market value and the life of the asset. If you know these terms or all but one of those terms, then you can calculate it. In the example above, if we really quickly said, you know what, it's an $11,000 payment. You can see that that would change things here. There is a function in Excel called goal seek, and if you go to data and choose what if analysis and goal seek, what you can do is you can have Excel calculate it for you. So here I would set this cell at the ending of the lease. At the end of the lease, the value is going to be 0 because the lease is going to terminate. And we don't know what kind of interest rate this is. So we're going to change that cell. We can hit execute and it will calculate it. So if in the example above, the lease payment was $11,000 a year instead of 10, then that would be a 7.08% interest rate. You can change other factors. For instance, if the fair market value of the asset were $50,000 and we didn't know what interest rate it was, we could go back, what if analysis, goal seek. We could change the ending value to be 0, and we need to calculate the interest rate. We can let it run that. That would be a 3.26% interest rate. So Excel can be used very easily and quickly to calculate those interest rates, even though you may or may not have the interest rate readily available to you based off of the contract or the lease agreement. So here are what the entries into the accounting system would look like for the initial purchase. We record the asset onto the books at the market value of the asset. In this case, going back to the original example, $45,000 for the backhoe and the note payable for the same amount. Then we would have the first payment, and here it is split between the principal of the note payable and the interest combined together are the same as the total cash payment going out. We use that Excel table to figure out how much was principal and how much was interest for each period. Each subsequent year, you would use the amortization table that was created when the lease was entered into to record the interest and principal payments. This example is simplified for one payment a year, but it can easily be adapted for monthly payments using months instead of years in the amortization table, and you would just have to record monthly journal entries. Please note that although I have not shown depreciation on the slides, that the asset would need to be included on the fixed asset schedule, and depreciation recorded the same way it would be for any other purchased assets. Also, we're assuming here that if a governmental entity is participating in a lease that transfers ownership, it's usually using the lease to purchase an item. And I have only presented this from the point of view that the government is the lessee and not the lessor. You can look at the implementation guide for GASB 87 to see other examples where the governmental entity may be the lessor and transferring assets. So now we have determined the leases that may exist in our entity. We've also looked at two of the attributes. The first is the lease term, and the second is if the lease transfers ownership. If the lease term is less than 12 months, we record it as an outflow of resources or expense for the lessee, or if the entity is the lessor, an inflow of resources or revenue. If the lease transfers ownership, then it is treated as a financed purchase. We record the asset and debt with the applicable footnote disclosures. So what about everything else? Leases that are over 12 months and don't transfer ownership. This last bucket describes all other leases, and we will look at it from 2 points of view. The first is the view of the lessor, and the second is the point of view of the lessee. The lessor will do a few things for leases. First, they will need to recognize the receivable and the deferred inflow of resources, both balance sheet transactions. I have a bullet here for expensing initial direct costs. Examples of this might be costs to get the equipment there, cleaning or remodeling space if it's under the capitalization policy. There are some regulated leases that can be excluded. For instance, if the lease rate is determined by a regulatory agency, or if the lessor can't deny a lessee from entering into the lease. And what comes to mind is for municipalities generally, which would be electricity leases, which are very highly regulated. How do we know how much needs to be recorded as a lease receivable? You will include any fixed payments, variable payments that are tied to a rate or index, or that are established or fixed in substance. Now this sounds pretty convoluted, and really in order for you to have a variable payment fixed in substance, you've had one too many lawyers work on the lease agreement. To make it as simple as possible, if you have more than one possible payment schedule, it's variable. If one of those payment schedules is realistic, you use that. If one or more of those payment schedules is realistic, but the lessee has to make one of them, they don't have a choice, you would use the payment schedule that is the smallest. And if there's guaranteed payments at the end of the lease, they would be included as well as estimated uncollectible amounts, which would reduce the lease receivable. Also, any lease incentives should be added in. You'll need to exclude variable payments based on future performance. A good example of this is a copying machine lease that may charge extra based on the number of copies. Those extra amounts are excluded from the lease. In order to discount future lease payments, one area that governments have struggled with is the lack of a stated rate, or an overly complicated calculation to find an implicit rate. You can use the GASB 87 implementation guide for details on rates, or use an Excel calculation, or simply use the entity's incremental borrowing rate. For practical purposes, if you've issued debt in the last year and the lease is not significant, use the rate from your last borrowing. And we went over an example using an Excel spreadsheet to calculate rates. This slide shows the two-step process when a government acting as a lessor receives payments on a lease. First, you'll record the cash coming in and the corresponding reduction in the lease receivable. The second part is to recognize the revenue, which is done by reducing the deferred inflow account that was created when the lease was created and recognizing the payment as lease revenue. On to accounting for lessees. Lessees have a lease liability that needs to be recorded at the present value of the expected lease payments, which will include the fixed payments, variable payments tied to a rate or index, penalties for termination, and any other payments which you are reasonably certain will be required based on the entity's knowledge at the inception of the lease. Two examples are the cost of exercising a purchase option, or if there is a required guaranteed payment. The lease liability will be viewed in subsequent reporting periods for changes such as changes to lease terms or interest rates or other relevant factors that could change the lease liability. There's also a right of use asset which is recorded on the books of the lessee at the value of the lease liability, plus any payments or other direct costs to put the asset into place. This asset will be amortized over the life of the asset or the lease term, whichever is shorter. So in our example before, it was a 5-year lease and a 15-year life on the backhoe. If that was a lease that didn't transfer ownership, we would amortize the asset on the books at the shorter of the lease term or the life of the asset. This is an example of some of the changes to an entity's statement of net position. The asset being leased is added with the title right of use asset or right to use asset. Amortization is deducted with the net value of the right to use asset shown, and then the lease liability is split between the current portion, which is payable in the next 12 months, and the long-term portion, similar to how other debt is presented. Here we have a couple of resources. We have the Local Government Resource Center, which has information on various topics. For this presentation, there is an excellent article from the Journal of Accountancy on lease accounting for governments. And here's a link for the GASB website. That's where you would find the implementation guide and the actual standard itself. My name is Seth Oveson. I'm a supervisor with the local government division in the state auditor's office. Hopefully this has been a productive use of your time to learn a little bit about leases. Here's my contact information. If you have any questions, please feel free to contact me. Have a wonderful day.